If your emergency fund is sitting at one of the big 5 banks, here's what you earned last year: $1. You have $10,000 saved. Many big banks pay 0.01%, and your reward for years of disciplined saving is a loonie. The exact same $10,000 in the right no-fee account can earn $275. Same money, same zero risk. Both of them are CDIC insured. The only difference is which app it sits in. I'm Janine, I'm a CPA, and I don't care which bank you're loyal to. And by the end of this video, you'll know exactly where your emergency fund should live in 2026, which 5% offers are actually math traps, and the one account confusion that costs Canadians real money every year. Quick disclosure, some of the accounts I mention are affiliate partners, and those are linked below in the description section, but the rankings are the rankings, and I'm going to show you the math so you can make sure that you check for yourself. 30 seconds of definitions, because there's always a mix-up here that genuinely costs people money. An HISA, or high interest savings account, is just a savings account that actually pays you interest. And it's where your emergency fund should live: safe, liquid, and boring. You can pull money out tomorrow with no penalty and no market risk. Now here's the confusion. An HISA is a type of account. A TFSA is a tax wrapper. They are not competitors. And here's where it goes wrong. Banks sell products called TFSA savings accounts. People put their money in and earn like 1% and think that they're actually investing. But what they've actually done is just put money in a savings account within their TFSA. So here's my rule. Your emergency fund goes in a regular, non-registered, high-interest savings account. Why not the TFSA? Because your TFSA contribution room is precious. It's the most powerful tax shelter Canadians have, and it should be holding investments that grow, not cash earning 2%. Tax sheltering the interest on $20,000 of emergency fund savings might save you a couple $100s of tax while burning the room that could shelter decades of market growth. I did a full video on the TFSA. It's linked below, so you can check that out if you're interested. Before the rankings, here is the checklist of 4 things that matter in order of importance. Number 1, CDIC insured or the provincial equivalent. Your deposits are protected up to $100,000 per category per institution backed by the federal government. Every account I recommend today has this or the provincial version. If you have more than $100K in cash, split it across institutions or account categories. Number 2, no monthly fees. A fee turns a 2.5% return into a negative yield account really fast, especially on small balances. This is a non-negotiable. Number 3, real access. Emergency funds need to move in like a day or 2. E-transfers, linked accounts, no withdrawal limits. Number 4, the rate, because the rate is where the marketing games live, which brings me to the trap. Every big bank right now is waving a shiny number at you. Simply Financial has 4.6%, Tangerine 4.5%, CIBC, BMO, they all have similar sounding rates, which when you compare it to 2.75% sounds great, but you have to read the fine print. Those rates typically only last about 5 months, and then you drop to the base rate, which can be as low as 0.3%. So let's do the actual math on $10,000 over a year. For the promo account, 4.6% for 5 months and then 0.3% for 7 months is about $209 in interest. The boring steady account that has a 2.75% rate is $275. The worse rate actually wins by $66. The promo isn't a scam. It's just designed for people who won't do the math and who definitely won't move their money again when the promo ends. Banks call it a teaser rate for that reason. So unless you're going to set a calendar reminder to move your money after 5 months, and some people absolutely do this, and I think that's great, then I would recommend picking the highest non-promotional rate available to you. Okay, here's the landscape as of July 2026. The big banks: TD, RBC, CIBC, BMO, Scotiabank, standard account rates are 0.01% to 0.03%. And that is not a typo. This is what I'm calling a loyalty tax. You pay it because you can and because switching feels hard. And most people never do it. Now, for my top pick, I'm going with EQ Bank. Their personal rate is up to 2.75%, 1% plus a 1.75% bonus when your direct deposit hits that EQ Bank account. There is a minimum of $2,000 a month for this. There are no monthly fees, no minimum balances, and unlimited free e-transfers. It's CDIC insured and it works like a checkings account. If you don't want to move your paycheck, the base rate alone is not the top. But here's why I think this package wins. This is the account where the whole system is actually built for your money. EQ has a notice savings account that has a 2.75% rate if you accept a 30-day withdrawal notice. But for an emergency fund specifically, I'd stay away from this and just use the everyday account. Emergencies typically don't give 30 days notice. The runner-up is Wealth One at 3% on balances over $25,000 and 2.6% on balances below $10K. Currently the highest non-promotional rate in Canada, also CDIC insured. Now, the best hybrid account is Neo Financial, 2.25 base up to 2.75% depending on your balance. There is no fees, no minimums. It is CDIC insured, and the base rate applies from $1. Genuinely strong if you're already in the Neo ecosystem, which I am, and this is where my emergency fund lives. Now, I want to talk about the one that's changed. This is Wealthsimple. You're looking at 1.25 to 2.25%, again, depending on how many assets you hold with them. Now, I have to be straight with you. This account used to be near the top, and if you opened it a while ago, you might think it still is. But today, the rate can be as low as 1.25% unless you have $100,000 in assets with them. Then the rate is 1.75%. And if you have $500,000 with them, you can get 2.25%. Now, Wealthsimple is still excellent for investing. For an emergency fund where you're trying to get the highest rate possible, the cash account is no longer that competitive at the entry tier. So check what yours is actually paying you. Now, an honorable mention, Oaken Financial at around 2.8%, as well as Coho, which pays between 2% and 3.5%, but does require a paid plan to get the higher rates of return. So run the fee math first. You might also consider checking out your local credit union, and you may be surprised at the rates they can offer you. So let's make it concrete because percentages don't hit like dollars do. Say your emergency fund is $20,000, about 3 to 6 months of living expenses for a lot of households. At a big bank, this could mean you're making as little as $2 all the way up to $60 per year, depending on which account they've got you in. At 2.75%, however, you're earning $550 a year. So again, that is roughly a $500 loyalty tax every single year for money just sitting there either way. Over 5 years, that's costing you $2,500 by simply not filling out one online form that can take 15 minutes or less. And to be clear about expectations, rates today are lower than they were in 2024 at the peak because the Bank of Canada has cut rates throughout 2025. A high interest savings account is never going to make you rich. It's not supposed to. It has exactly one job: to keep your emergency fund safe, liquid, and not shrinking against inflation. If you want growth, that's what your TFSA is for. And make sure that your money is not sitting in a savings account within your TFSA. It needs to be invested. So here's the whole playbook. 1, look up what your savings account is actually paying you right now. In your banking app, if there's a 0.0 anywhere in that number, keep watching. 2, pick the account you're going to move your funds to. EQ is great if you're going to move your direct deposit. Wealth One is great if you have over $25,000 to invest and you want a maximum steady return. And Neo Financial is great if you want a strong, no strings attached base. Number 3, open it online. I promise it's going to take you less than 15 minutes. You don't have to go into a branch. You don't have to pick up the phone. There is no breakup conversation with your bank. You don't even have to close your old account. You can simply just open a new account with an online bank. And number 4, move that emergency fund over and set up an auto transfer, and you don't have to think about it again, except for maybe once a year when you spend 5 minutes checking to see if that rate is still competitive. Rates change. Loyalty shouldn't be free for your bank. And if you're now wondering whether some of that cash should be in a GIC and locked in for a guaranteed higher rate of return, that is the next right question, and I'm happy to cover it in a future video. Just let me know in the comments section below and subscribe to my channel so that you never miss a video. Links and the full rate comparison table are in the description below, and I will see you next time.